Let's bring in the Chartmaster, Carter Worth. He says there could be even more downside ahead. Carter, why don't you lay this out for us? What are you seeing?
You bet. Hi, team. So before looking at the charts, I mean, you've covered key words. Dan, damage done. That's exactly right. Guy talking about trend lines breaking. And so let's look at the charts and figure out where we might be headed. The first chart is just the chart of the S&P, and you can see that it is a perfect 45-degree angle. No other way to characterize it. And we have broken trend. You can see the trend line and you can see the break. Look at the second chart. Now, this is the exact same chart, exact same time frame, but you see this distribution pattern. That is the damage done. That is a head and shoulders formation, if you want to name your patterns, but it's what distribution looks like. You get that crack. Last Monday, we rallied back, and then we're cracking again. Now, look at the third of the four charts that we have here this evening. This is 1 and 2 combined. So what do we have? An uptrend, a perfect uptrend, a perpetual motion machine. One group, next group, rotate, and yet it's starting to fray. We have a break in trend, we have a head and shoulders formation, and then the final chart, where might we be headed? Well, one thing we know, this is only the 13th instance in history where the S&P has gone more than 12 months without a check back fully to the 150-day moving average. And that comes into play around 42.35. So on last Monday's low, we were down 5.2%. We're only down, if you think about it, 4.3, 4.4, and yet it feels like we've been in a war. The truth is, I don't think the market's really ready for any real selling pressure because we haven't seen any in so long. 150 days is the first stop. We'll see from there.
So 42.35. And Carter, we had you on just on Friday talking about rates. And basically, from what I understood, you said that rates would only go so much higher from that point on. So is this drop that you're forecasting to 42.35 in the context of rates coming back down?
Well, interestingly, I think if and as this gets worse, you'll start to get a flight to safety, and rates won't really spike. And Tim referred to that. It's only so far they can go in this particular sequence. It's been a big move, and this is where you likely actually don't keep going because the consensus is once again calling for 2 and 3 and all these quite hysterical things. I don't think any of that is coming.
And mathematically, Carter, the traders are talking about tech and with a decline in tech, rotation out of technology, the other parts of the market simply aren't big enough. You talk about this a lot in terms of mathematically, but at some point, tech has to pass the baton. So what are you looking for in terms of new leadership?
Right. Yeah, I mean, I remain in the camp that you want to stick with companies that are, quote, long-term prosperous. They're not cyclical, right? They're disruptors. That's what investing is, independent whether you call it value or growth. Investing is finding something that has a long arc of prosperity. Digging around in the dumpster and finding a cyclical for a bounce, you caught it for 9 months, then you got out, then you got back in, that's hard work. And I think you stick with the marquee names over time.
So cool, Carter, it's Tim. And the two charts that I think investors should be focused on that had interesting days on the breakout or the breakdown, semiconductors, so look at the SMH and the dollar. One or the other more important to you, and anything you saw there, because these are both stocks or indices that I think are telling a lot about where the market concerns are.
I think you're exactly right. And one, of course, we know the dollar has all the hallmarks of a bearish to bullish reversal, something that's been weak, that is curling up, carving out a bottom. The other is a heretofore great winner, semis that have basically been stalled for the better part of 7-8 months. And while they haven't really broken trend, that is the risk. Again, do we, though, play for stocks like U.S. Steel and Nucor or an energy that in any given day drop 7-8% after they rally 7-8%? Not my thing. I think it's a hard way to make money. I'd rather stick with the names that over time have been great market leaders.
Hey, Carter, it's Dan. You know, one of the things that I've been tracking over the summer was the kind of disconnect between that ARK Invest innovative ETF and Tesla, which is its largest holding. Tesla has gone up 15% since July 1st, and ARK has gone down about 15%. And when you think about a lot of the other names in that top 10, there's supposedly these innovative names, all very high valuation. Most of them are down. Most of them are down a lot from their 52-week highs, that sort of thing, earlier this year. What do you make of that under underperformance from some of these prior high valuation winners, and then this disconnect between Tesla. The ETF in and of itself is not a big deal. I just think that it's captured a lot of mind share among retail investors, which is one of the reasons why I'm taking a look at it.
Yeah, spot on. I mean, if you were to look at a chart, a comparative two-line chart of Tesla and that ARK ETF, they're literally parallel lines until the last 3 months where they're diverging. And a lot of the constituents in the ETF are rolling, just as you said, where their moving averages are flat and or actually inflecting lower. And Tesla, for whatever reason, is taking on a defensive characteristic. It sounds crazy to even say that, and yet it is. Its relative strength over the last couple of sessions is nothing short.
Carter, always great to hear from you. Thanks so much. Carter Worth of Cornerstone Macro. Dan, I'll go right back to you on that chart because, as Carter mentioned in his very last comment, Tesla's been a relative outperformer in the past 2 days, particularly today when we saw the Nasdaq down 3%. Yeah. Tesla's losses were just a fraction of that.
Yeah, so that's one of the reasons why we also bring that up, because ultimately, if they join the party to the downside, Tesla is the 6th largest name in the NDX. Those top 6 names make up half the weight of that index of 100 stocks. And again, I'm tracking this from this relationship from a sentiment standpoint, right? What have we seen so far this year? We've seen IPO high valuations get killed. We've seen crypto off the highs gotten killed. We've seen SPACs off their highs getting killed, that sort of thing. So I think this could be one of the last pieces of the puzzle in the break of Alphabet and Microsoft today, of those one-year uptrends. If Tesla's to join the party, then you start getting this kind of steamroll effect a little bit, and that's how I think you probably achieve those lows near 4,100 over the next few weeks in the S&P 500.
We talk about FANG a lot and the importance of FANG in holding up the NDX, but Tesla, we sort of forget that it's gotten all the way up there, guys. So is that the last sort of key to the puzzle here in terms of whether or not, the markets will actually break?
Yeah, a key without question. I mean, but the stock has had a significant run to the upside. So, in my opinion, Tesla, you have to be talking about Tesla with like a 650 handle for me to get concerned in terms of its scope in the broader market. I think to Carter's point, staying with things that have worked, I think you're trying to figure out where you're looking to re-enter some of these names. And we've talked about Apple, if you want to get granular for a second. I mean, this 141, 142 level makes sense, but we've seen a number of peak to drop declines anywhere from 15 to 30% over the last 3 years, and I think we're in the midst of one now. So if Apple were to trade back to 135, which if you go back and look, that was a prior all-time high, I think, back in April, that's a 15% move. That lines up perfectly with what we've seen historically. I think that's the way your mind has to be working right now.